For all of you joining, I see you all coming in. We're going to give it about a minute to make sure that everyone is on before we get started. Thanks everyone for joining. The numbers are still going up, so we're just going to give it another 30 seconds or so, and then we'll start. Okay, I'm going to kick off. I know we still have people that are going to be logging on and joining us, but we have a lot to get through in this next hour. So good afternoon, everyone. I'm Margaret Mueller. I'm the president and CEO of Exec Club. It is my pleasure to welcome you to our third annual VC Outlook event. It's always a fascinating conversation. We can't wait to get started. Before we do, I want to thank our signature series sponsors whose support makes all of the programming that we do, like today's, possible. Could not do it without them. We're so grateful. We've also had a phenomenal season so far, much more to come. The best way to experience all we have to offer is by becoming a member. So visit executivesclub.org for more information and opportunities to engage. So now let me introduce today's moderator, who is well known to most of you, probably needs no introduction, but Professor Steve Kaplan. Professor Kaplan is the faculty director of the University of Chicago's Polsky Center for Entrepreneurship and Innovation. He conducts research on private equity, venture capital, entrepreneurial finance, corporate governance, and corporate finance. And Steve will be joined by a panel of our returning experts, Sach Chitnis, Antonio Gracias, and Mar Hershenson. We are grateful to have them with us all. Without further ado, take it away, Steve.
Great. Well, thank you, Margaret, and welcome to everybody. I am delighted to be here again with our terrific panelists, and we will enjoy hearing from them. But first, as usual, I am going to begin by giving you some macro thoughts about the status of tech and venture capital. And I hope you can see my slides on your screen. And here goes. So, 2 years ago, we were in the golden age of VC. University endowments were minting billions, and everybody was gung-ho. A year ago, it was a little more dour. Tech bubbles were bursting all over, and we talked about that. It was the end of the golden age. And this year, we've actually had a little bit of a tech resurgence. And so, you see AI gave tech giants, trillions of dollars of boost in market cap. And that continued today, which has been also a terrific day for everybody. And, but at the same time, VC underperformed for another year. So there's sort of this disconnect now between sort of the public tech and the venture capital. So we're going to see what that means going forward. But let me give you a little bit more data. And so I'm going to talk about, where returns have been in the public markets, then talk a little bit about what's gone on in venture capital. So first, since we were last here about a year ago, returns have actually been pretty good. So this is as of Friday. These numbers would be higher today. But the public technology is up 55%, NASDAQ 31, the S&P pretty good at 26. But you can see there's a large cap thing, and that the Russell 2000 is only up 5%. Now, what's really fascinating when I did this is what's up the most since we were last here? Bitcoin. Bitcoin is up 92%. I haven't been following it, but oh my God, that's amazing. And then, you can go through January 1st and again, 2020 rather, so go pre-pandemic to today. And technology is still up, quite a bit, a double basically. The S&P is up half that, and the Russell, again, small cap has been terrible relative to large cap. And again, the amazing thing, Bitcoin is up 4 times since the beginning of 2020. So for those of you who haven't been following, that was a surprise to me. But bottom line here, public tech has done pretty well. Now, how about venture? And this is where you look at how venture funds have done over time. And each of these dots is just venture capital funds raised in a year, how they've done. And that's IRR. This is MOIC, which is multiple of invested capital. And what this is showing you is venture capital funds that were raised since the great financial crisis have actually returned 3 times your money, 2 times your money. The black is the average, the red is the median. And so those are still pretty healthy numbers. This is as of the end of it's July 2023, which is the most recent numbers. It's not like it was in the dot-com days over here, but it's still post GFC is still pretty healthy. And you can then, this is a comparison of funds to the S&P 500, again, this is all funds over the last 20 years. And what's interesting here is, as you saw, the S&P 500 has done very well. That's been a tough benchmark over the last 3 years and really over the last 15 years. And venture capital funds have pretty handily beaten the S&P 500. Again, the black is the average, the red is the median. It's even the median fund has beaten the S&P 500 by about 20% over the life of the fund, 40% average. And so that means if the S&P returns were 100% over this period, venture capital was like 130, 140. So outperformance cumulatively, despite sort of what you read about the negativity about the golden age being over. Now, what you can see, this is just annualizing it. Annualized, it's about, I don't know, 5 to 10% a year outperformance. Now, the thing that has happened is a year ago, I would have shown you these numbers, which were the outperformance was a lot higher, and venture has given back a fair amount of that outperformance this year as the S&P 500 has gone up and the venture marks have come down some. So what will be interesting to see is where this green is going forward, and that'll be a question that I have for our panelists as to where this is going to go in the next couple of years. And again, this is the annualized, and you can see this is where we were last year. This is where we are this year, which is still pretty healthy. And it's about where it was pre-pandemic, a little bit higher than pre-pandemic. So that's the returns, and the returns are still, they're lower than last year, but they're hanging in there. Investment is down. So you can see 2023, this is venture capital deal activity way down relative to 2021, but actually not all that different from 2018 and 2019. And seed is actually the seed deals are actually hanging in there. The early stage, it's down, but again, sort of where it was pre-pandemic, and later stage as well. So you see in all these patterns that it's down relative to the sort of pandemic, but it's kind of about where it was pre-pandemic. And the thing that is really down, and again, we'll want to have questions about whether it'll come back, exits are way down. So exits were amazing in 2020 and 2021, and they're amazingly bad last year and this year, even relative to pre-pandemic. And fundraising, which tends to go along with exits, is also pretty low. So you see a lot less money raised this year than even 22, but certainly, both those years and less money raised than pre-pandemic. So that is the bottom line. Their tech has come back, venture not so much, exits way down. And let's talk about where we go from here. So what I'm going to do is what I normally do is start by asking each of the panelists to briefly introduce themselves, tell us what their funds do. And you will want to pay attention to what they have to say, because as I introduce them, I'm going to tell you what they said last year. And last year they said some pretty cool things, and they didn't say anything that was wrong, and they each said something that was pretty right. So let me start with Sach Chitnis, who last year we asked him about crypto, and he said he was still bullish. And as you saw, Bitcoin went up 90% this year. So if you'd listened to him, you would have basically doubled your money. So Sach.
Even a broken clock's right twice a day, right, as they say. Sach Chitnis founded Jump Capital over a decade ago, and we're on our seventh fund, a 350 fund, but we focus on Series A, typically companies that are about $1 million in ARR and looking to scale their ambitions. We spend a lot of our time focused on fintech, IT and data infrastructure, AI, cybersecurity, et cetera, as well as B2B SaaS. I'm based in Chicago, but we have offices in New York and LA.
Great. Well, welcome, and thank you for being here. Next is Antonio Gracias, and Antonio, you can find in Walter Isaacson's biography of Elon Musk if you want to learn more about him. Last year, he also got one thing very right. He told us that he thought NVIDIA was, and I quote, super oversold. So if you bought NVIDIA after listening to Antonio last year, I believe you have more than tripled your money. So Antonio.
Thank you, Steve. I think I should probably leave the call now, since I got a good call last year, not go again for this year. So yeah, I'm Antonio Gracias. I founded a firm called Valor. It's based headquartered in Chicago, offices in New York, Seattle. We're a multi-stage firm, so we have about $1 billion in early stage venture. Last fund was raised in 22. It's 650, mostly around sustainability on the venture side. We have growth funds. We run our sixth growth fund. We just finished raising that this year, so it's a 23 vintage. It's been a tough fundraising, as you know. At $2 billion in the cover, we raised $2.3 billion. So very happy about that. Pleased with the performance of the team, and very, very grateful for our clients. We invest in everything. So we have teams working on several verticals. What I do is really what people call hard tech. So artificial intelligence, space, energy, the stuff I find really interesting. I think I have the greatest job in the world, because I get to, think about really interesting topics, meet really smart, cool, interesting people doing great stuff, making the world better, and feel like I'm making a difference every day. So yeah, I'm happy to talk any of that fun stuff.
Great. Well, welcome and thanks for being here. And now finally, Mar Hershenson. And Mar, again, was on the Midas list of the top 100 VCs in the world. It was the second year in a row. And this year she was at 26. And last year, Mar told us that she was focused on generative AI. And of course, if you listened to her, you would have bought NVIDIA along with Antonio. You would have bought Microsoft, and you would have also done very, very well. What can you tell us about yourself?
Awesome. Well, thank you for having me here. It's always really fun to make predictions for the year with the three of you. My name is Mar. I'm the founding managing partner at Pear VC. We started Pear about 10 years ago. We're in our fourth fund. It's a $400 million fund, and we invest in pre-seed and seed companies. So super early. We are generalists. That means we invest in everything, ranging from biotech, healthcare, B2B, consumer, you name it. We're very founder focused, and trying to back companies that are, have the potential to be venture scale. So anyways, that's about us.
Great. Well, again, welcome to the three of you, and let's get started. So 20 and 21 were amazing years for the tech industry, maybe too amazing. 2022 and 2023 have seen a big correction, particularly on the VC side. And it's not clear what's going on with VC. So basically open-ended, how do you assess what's going on in venture capital now? Is the correction over? Are we still going to go down? And what are the dynamics? So Mar, why don't you start us off?
Okay, maybe I'll get started. I should say that in our job, we're generally optimists. Otherwise, we cannot invest because everything has reasons to, reasons for failure. But my read of the market is that, I think almost like we reached bottom, but there's still a lot of companies to clear up in our industry. I think we still have a year, at least, of companies that raised money in 21, go through basically the ring of fire. Either they're real businesses or they're going to shut down or, disappear. And we're not done with that. It's almost like there's a delay, and that still has to circulate in our industry. I think that's sadly going to translate to some of the last charts you showed, Steve, going down still. And, and it also will mean that the LPs will not be opening up their wallet a lot next year. Now, I feel generally long-term optimistic. This is not going to last forever. We're going to clean up the mess, all that bubbles that you showed, and eventually pick up again. I'm doing seed and pre-seed. So I feel the companies we are investing in, at least the founders, are somewhat aware that money doesn't rain. So they're building stronger companies. So I feel, cautiously optimistic on that seed, pre-seed where we are.
Very good. Antonio.
I would say this is a return to normal. So we were, the last couple of years prior to this year, were a bubble. And if you look at the data you just showed, Steve, right, you see the bar charts kind of all going back to 19, 18, 19, which is where we should be. And to echo what Mar said, I think a lot of stuff got funded that should have gotten funded in 2021, 22 during this bubble. Our model is driven by, high growth with what we call pro and triple companies. Companies get better when things get bad, and ROIC. And if you apply that lens, we didn't have a lot of companies that were losing money forever, but Mar's right. I mean, there's a whole sea of companies that are zombies that are either going to die or get recapitalized or figure out how to make money or not. And if they don't have return on capital, they won't survive. I'm doing a seminar this afternoon for our portfolio companies with a bunch of my partners about ROIC. And, we have some executives out there like, what's that? I have to put a return on this capital. I have to give them, wait a minute, $1 goes in, 2 come out. Is that how it's supposed to work? And, we tell them a business as an economic machine that has to, put $1 on one side, on the other side comes 2 or some more dollars, 1.5. I think that discipline's great. I think it's great for the industry. I think it's great for America. It's great for the economy. I think we're at the cusp of a massive productivity revolution in America, and it's just starting. So I'm very optimistic. I mean, it might take another year or two to cycle all out, but it's returning back to normal. Venture companies' valuation should be lower than public markets. It's illiquid. It's early stage. When you see software valuations in the private markets higher than the public markets, you got to scratch your head and say, wait a minute, this is a problem, right? It shouldn't be. It makes no sense. So yeah, I think we're getting back to where the way things should be.
So both of you sounds like you think the valuations still have little ways to come down, and then we'll be okay.
I mean, I would say that I think premium companies are still getting good valuations, premium valuations, but all the stuff that was a B or a C isn't getting funded at all, or it's dying, or it's getting bought, or getting recapitalized, taken out. I mean, it
hasn't been fully written down.
Exactly.
So there's pain to come. Okay, yeah. Such.
Yeah, I mean, I think just to feed off of that, I sit in this what I would consider the worst spot, which is the one that has to remind companies at Series A that the world has changed. It's a little bit more rational that B, C, D, late stage companies, they see the public markets and there's a little bit closer affinity to it. That eternal optimism that we have in venture is usually spawns from the founders at pre-seed, seed, where Mar sits. And as you start to scale, you try to operationalize it. So we see kind of like this barbell. Seed stage continues to be very active, no historical baggage from 21 or the like. And the activity is excellent, new innovations being funded daily. it really didn't skip a beat, frankly, at all. I would say the valuations have ticked down, but not tremendously. The late stage, and maybe I'll double click a little bit on what was being said. What people may or may not have realized is that most companies have rationalized their expenses, and they've done that at a cost of growth. And so those later stage companies just are not fundable, I would say, on traditional venture terms. And so they either have to get to profitability, be acquired, or shut down, right? Depending on what their circumstances are. That has not happened, I would say, at scale. So I think that there's going to be an interesting, if you have my prediction, I think you're going to see an interesting year with a high velocity of either tuck-in acquisitions, shutdowns, or we would call them zombie companies just kind of lingering and hanging out with without that, kind of high growth that we're used to. So I'm a little bit more pessimistic on the churn that needs to occur, but once it happens, I'm pretty excited.
I think, Steve, one chart that you haven't shown, or maybe a couple of charts, is like the number of companies shutting down. And you can see there it goes up, but it's delayed a couple of years. Or the number of companies that are doing bridge rounds, it's again still going up. So it's just shifted a couple of years. And, like everything, at some point you run out of companies to shut down, so it will come down. We're just a year away.
And I think what's interesting, just to maybe add on that, is that your exit chart is 100% the case, whether it's IPO, private equity, strategic acquisitions. And when you don't have that velocity, there's like this sand in the gears. It's really made it difficult for people to make those hard choices, right? It's easy to sell your company. Then choices are made for you. When you don't have options, and that's really what you're seeing out there, people are reluctant to make those hard decisions, I think.
So will we ever see good exits again?
Of course.
And when?
Of course.
Well, I think that the one thing, and I'm sure these guys would really opine on this even further, but I would say the good companies are really noticeable now. Like I would tell you, every company that we put in a term sheet has 3, 4, 5 offers. So the separation from the good, from the okay, is really apparent. And that exists in late stage still. So it's not everything and using one broad kind of stroke for everything, but I would say you will see good exits. And I think, those stand out tremendously. I'm sure Antonio probably sees it even further, right?
Yeah, I think that's right. I mean, it's definitely a tale of two cities. We see we've got some companies that have been funding at big premiums that are, like, I give you a few examples: Anduril, Zipline, both artificial intelligence enabled, making drones, for different applications. Very, very, I'd say, great companies with good return on capital potential and high growth, and they're all up rounds. And we have, we see other stuff in the marketplace that can't get done at all because no one wants to fund it. So I think you're right. Premium companies will continue to attract capital and, even more importantly, talent. Seeing a real, money's one thing, but where are the best engineers going? Where's the best talent going? I think people are being much more rigorous with the flyer, because they know they all got friends at companies that have gone to zero. And so you're seeing engineering talent really concentrate in some of the very, very best companies.
100%.
So that's on the back end. The front end, what sectors do you like? What is most attractive to you today? That's maybe where people can remember last year what you all said. Mar, you want to start us? Go ahead.
I can keep on going. I think generative AI is still a thing, and it's it's a little bit it's such a dramatic increase in productivity for some applications. We're not talking about 10x, but we're talking about 100x or 1000x for some things, right? I mean, you can create an image in a second rather than going off and hiring some graphic designer, telling them what you want, getting 10 samples, etc. So there's a lot still, I think, that needs to be built around this technology. It's in a way, I think a lot of people ask me, is it like the web? Is it like mobile? And it's a bit like, I think it's a little bit like the personal computer. Is the way we interact with computing is changing, both consumer and enterprise. We're actually spending a lot of time looking at consumer AI, which I think is crazy because nobody wants to do consumer. But there is, I think consumers are more forgiving in terms of AI being accurate or not accurate, or saying they're, going crazy for a couple of seconds. So I think that's been really interesting. And then, I think as Antonio maybe mentioned, I think there's 3 industries that are really interesting. At least I've seen a lot of deals that are both driven by market and also government. One is semiconductors. I'm a chip designer by training, just crazy, but I hadn't seen any semiconductor deals in 10 years. And then all of a sudden now we have people that are trying to build things to go head to NVIDIA's, trying to replace that software stack, ambient AI or AI on the edge, EDA tooling, anyways. And, there's the CHIPS Act, I know, national security, etc. Climate is another big one. Again, partly the Inflation Reduction Act, but there's real demand both from businesses and consumers to do something around climate. And I think ultimately what you said, Antonio, defense. There are some of our friends here in the Valley that instead of moving to Miami, they've moved to LA to be able to collect the SpaceX people. So, there's
What are you talking about? How can we never leave?
Yeah. So I've never seen so many people, so many investors interested in defense, right? And again, there's 2 wars going on. Hopefully that's it. But there's definitely both demand from industry and government. So it's interesting in that regard.
You want to go next?
Sure. Go ahead.
Yeah. So I'm gonna stick with the analogies here because of what this looks like. I think it's like the Industrial Revolution. I think artificial intelligence is like the Industrial Revolution. I would say it's that big of a step function change. We're coming out of the dark.
So bigger than mobile, bigger than the internet, bigger than the PC. So this is big, big, big.
Much bigger, much bigger. I think the impact, and I think we're just at the beginning of it. And so you're seeing, and look, I think the impacts are the positive impacts are yet to really be understood, because the negative impacts are being very vociferously, loudly talked about all over the place, right? The Terminator future, and there could be no jobs, unemployment in the streets, people could be rioting. Well, I got news for you. We got too few people in America working right now. The employment population ratio is still below pre-COVID levels. We have the labor markets are broken. You know how they get fixed? If artificial intelligence, just even the call centers, takes out half the call center jobs, well, there's people who start working in the restaurants now and other places in the economy. So we get proper labor in the stores and shops and all the service economy can't fill right now. Hotels, all those jobs aren't being filled. So I think that the negative impact of artificial intelligence in the short term is being overstated. Now, whether it takes over and kills us all is a different matter, but the negative impacts on employment are being overstated. We started investing in artificial intelligence in 2009-10 with DeepMind. I've been working on it for over, kind of 13, 14 years. And our thesis has always been infrastructure, that is the stuff in the data center and around that supports it. So I'm excited about chips and things in the data center make chips faster. The average NVIDIA GPU in a data center today is kind of utilizing 30 to 50%. It's a huge, huge improvement in return on capital that's going to be achieved here through a series of small incremental improvements to data center. We have a number of companies in that area. And then we're interested in artificial intelligence applications that we call vertical applications. So there's a data moat, some specialized proprietary data that integrates with a customer function. It could be hardware or software that creates reinforcement learning. So my statement for this year, people can write down, is I think that the valuations in generalized LLMs are way overblown, like way overblown. I think that 90 billion ChatGPT and OpenAI is insane because the fastest depreciating asset probably of all time is the modeling of an LLM. I mean, the depreciation curve is insane, right? So if you can train on the internet and your reinforcement learning is all humans or no humans, just reinforces, self-reinforced learning, that is imminently replicatable easily by my 17-year-old son. And, these models are all commodities. The data is all a commodity. If you don't have something special that's protectable, you're dead. And I think you're going to see this happen in the next couple of years. It's going to look a lot like the internet in this way. There'll be lots of pet.com. You're trying to figure out who the Amazon is. And, Google may be the Amazon of AI. I don't know. We'll find out. But it isn't like all these LLM companies are going to survive. No way. There's a huge bubble here. And you've got to pick your spots very carefully in places where you have protectable moats that drive return on capital over a long period of time to build a real business.
Now, what about a Microsoft, which is tied in with OpenAI, but has its own, has plenty of moats going on?
Look, I think Microsoft, I'm not going to opine on the Microsoft stock price. I don't know it well enough. I will say that I think they've done a wonderful job of remaking the company. I mean, wonderful. Like they've done a great job of building a great business. So where the stock price goes in 12 months, I don't know, but they've done a great job of remaking the business. I think the data center business across the board is going to be a great business for the next several years because all the capital being spent on GPUs is going to be optimized in the data center in the next couple of years. As you see technology, chips, and other things that operate behind the GPU get faster, memory and chips get faster and faster and faster, return on capital is going to go up. So they're going to overbuild for sure, but there's going to be high utilization. And then I think the rest of their business, OpenAI, with or without it, it's going to be a great search engine. So, they'll probably do well. Better than Bing, for sure.
Good. No, yeah, I don't know if you know this. Sach Nadella was a student of mine back in 1996, 97. So I'll take a teeny bit of credit. I didn't mess it up.
You did a great job teaching them how to remake the company. Well done, Steve.
Sach.
Steve hasn't figured out how to tax future earnings yet from his students.
That
would be a good
It's
model.
called our endowment, right?
I send him a check every month, man. You guys don't pay Steve? I pay Steve every month. You don't send him your check?
I'm a Northwestern grad, so it does go, but it goes to the wrong school, evidently. Yeah, I mean, maybe I'll hit it in a couple of ways. One, on the AI front, I'm of the belief, like these guys, that it is a tremendous revolution. I think we're in really early innings, and when we talk to enterprise, I think I would best describe their utilization as dabbling at this point. And what gets you excited is about where it can be embedded versus a totally different vector. So whether you use crypto or internet, those were just kind of separate, isolated areas versus the permeation throughout. So think of the three vectors that we look at within AI. Efficiency, there's tremendous opportunities of efficiency, customer engagement being that second, and there's a lot of opportunity for that engagement and experience. And the third is the product and IP development. And when you talk to most enterprises, big FANG companies and the like, they're really in early innings of just kind of exploring these areas, more focused on efficiency at this point. When it comes to other areas, I have this kind of general macro perspective on that the world is just more isolationist and protectionist, right? And when you think about that, for me, that has a lot of impact on data security, even the speed bumps that you see out of presidential kind of oversight over AI. There's just a lot of people wanting to get their hands in. So when it comes to taxes, when it comes to regulation, I just get very excited about the technology layers to help enterprises operate through that quagmire. And for me, it's not a good quagmire, but I do think it's definitely going to grow. So reg tech is a hot area. And then the third for me is efficiency. As we saw in like 09, 10, 11, 12, the efficiency that most companies saw was tremendous. And that's what created a lot of new jobs, new opportunities. And so I think that, like, when you think about enterprise solutions, the power is going to go to the CFO, where it was with the CISO, where it was with the CTO, and the head of sales. You'd throw money at problems and solutions. I think the CFO is going to be saying, let's do more with the same people. And I think leveraging technology and some solutions to kind of assess where to spend the money. So for me, those are the three that I'm spending time and thinking about in the next 12 months.
Mar?
Yeah, I want to say something about this, doing more with less people. It seems, I don't know, this is my view on humanity. And you can do we can make predictions about what the world is going to look like in 10 years. But I heard the CEO of Goldman do a explanation of AI. And he said, I was an analyst before the spreadsheet was around. So we would literally have to go to the library, take down, what the stock price was, and go and draw by hand some chart. And obviously the spreadsheet comes along and all the analysts are so much more productive. And the number of analysts doesn't go down. In fact, it went up, right? Because you're making this person so much more powerful that they're able to do more things, right? So I think it's, to your, Antonio's point, it's like a leap in humanity in terms of productivity and how much we can do, right? So AI is I'm not sure we'll have less people. I think we'll have more people, the same amount of people. We're just going to be more powerful as a race.
I agree. Not to step on your comment. I mean, I totally agree with your sentiment. For me, I think most CFOs are thinking about doing more with the same number of people. And I think what I'm seeing more and more of is repurposing them. So they may not be the same number, it may be the same macro number of people, but they're repurposed. Now, it could be Antonio's comment, like we may not need that call center or the number of people in that call center, but now I can apply it in sales reps or other functions. So for me, it's the reskill. I get excited about areas like reskilling and retraining because the cross-functional nature of the business is going to make people more versatile. But I think that I agree with your sentiment. It's just when I think about all these innovations that have occurred, it usually opened up new areas for job growth. This doesn't mean there's going to be less jobs, for my view. Yeah.
Now, how do you, that's a question I get. How, if you're an executive, so someone in our audience, how do you experiment with this? You say they're dabbling. How, if I want to do more than dabble, what do I do? And do I engage with you? How do I get there?
I'm happy to jump.
Oh, did Antonio just freeze?
Lost them.
Oh no. Well, he'll come back. Okay.
I don't know what the audience, who the audience is, whether it's enterprise or consumer folks.
Where I
But
use
I
that.
think
Oh, there he is. Okay.
I'm sorry, I lost you. I said I would just experiment with it. I mean, it's so easy to use. I would just open up ChatGPT, open ChatGPT and use it. I mean, I've got X Stick Rock on my computer and phone here, and it's awesome. I mean, it's super fun to play with. And if you're excited and curious, just start playing with it and see what happens. So I've got 8 people at my firm that are actually building artificial intelligence for our investment process, but PhD mathematicians and programmers and UI guys. But they're doing that stuff. But I'm actually playing with myself. I'm product managing this myself because I'm so interested in what it does. And we're building models that are boosted trees, using LLMs and classical models, and it's just really cool to play with. Just go play with it. If you're a CEO in a company, play with it yourself, and then go get your programmers and start playing with it. That's what I would do.
I think ChatGPT made AI accessible to everybody, right? That's why they got to 100 million users in a couple months. Just accessibility, the same as the browser made the internet accessible to a bunch of people, right? Or the PC made computing accessible. So there's no excuse. You can literally go and start having a conversation. You can go to ChatGPT or go to Character AI and make a friend if you're lonely. So that's really cool. The other thing you can do, actually, if you're an investor, I don't know how many people in the audience are investors, but I actually decided, hey, I'm going to use AI to make a slide deck. And, there's like 30 companies doing slide decks using generative AI. So you can try all of them. And then you realize, oh my gosh, there's a great opportunity to build a great company because all of them suck. So you can do that for almost everything. You look at the legal tech, if you're a lawyer, you look at the legal tech companies. For years, we couldn't invest in legal tech because the market was too small. There's not enough lawyers to sell them enough software. And then, all of a sudden, there's like 50 super well-funded companies in legal tech. Well, at least you can try it. So if you're a law firm, go and do an RFP and try a bunch of that stuff to get a sense of, what's going to be the norm eventually. Anyway, it's so easy. It's so cool. I think it's just so cool that you only need time to get knowledgeable.
One thing I'd layer in there is that when crypto started happening, I think there was so much learning, but without any ability to actually do anything, right? I mean, when you think about like what fundamentally changed in your life when crypto came out, you could trade it. That's it. Maybe invest in Bitcoin or not, right? With AI, like whether you're planning a vacation, you're a lawyer and you wanted to create a brief, if you wanted to create an image, any of these kinds of things, the consumer ability to access it today, it's literally just typing in the word AI tool to, create a vacation. And it will give you that opportunity to actually touch it, feel it, and see what it's capable of at even the smallest level. And I think there's just so many companies, thousands that have been funded and started that are just kind of doing these use cases. So there is a lot of point solutions that you get to play with it, which is very different from a lot of other innovations that existed.
I might add one thing to this, which is last year on my birthday, I was getting so busy that I realized, and there was so much going on in the world, that I no longer had time to think. And so one of the things I did, to this point about playing with it and thinking about stuff, I actually put 2 hours on my schedule every day to read, study, and think. And I recommend if you're a C-suite, if you're a C-suite executive somewhere and you're worried about the world and AI and all, I mean, just stop for a minute, put some time in your schedule, and just go play with it and think. It's amazing what happened when I did that. I created some space in my schedule to do that, just to play with the technology and study and think. I read Google's 2017, you know, his attention paper. I did all this stuff, and it was really great. I mean, I really learned something. It was cool, and yeah, it was insightful for me. So I recommend that too. Make some time to think and play with it.
Well,
Time is greatest luxury.
Yeah, did you take that? What did you take that from? Did you take that from sleep or what? I'm just joking.
No, actually, I didn't take it. I don't know. I just realized I was running around looking at a bunch of stuff, and I was not pausing to really think about the meta idea what was going on and learn enough about the deep tech, the underlying technology to understand it well. So I stopped.
It's good. Actually, I think this is an interesting, and one more thought that I think dawned on me and is really interesting. I also have teenage children, and my son was planning in the summer some beach party, and he was going to send an email to his group of friends. And rather than writing the email, he was trying to find an AI company online to create a flyer. I'm like, I don't know if that exists, right? But that's the way the new generation is thinking. They're not even thinking I'm going to write it. It's what software creates that flyer for me. So if we're not playing with it or understanding, we have a lot of untraining to do to, you know, think like the new people that come up.
Okay, so AI is going to be big. It's bigger than anything that's come before, which is it's very exciting. I mean, that's you were all in the middle of it. So to hear you be so excited is very, you know, what do I want to say, inspiring and exciting. So now let's go back. Actually, Sach, you just mentioned blockchain and crypto and you were all last year cautious but bullish, and you were focused on building infrastructure. FTX imploded after we did our thing last year. What's happening in blockchain and crypto?
It continues to be a winter. I mean, just to be very clear, right? I mean, whether you look at it from like a trading volume perspective or new companies being created, what I would say that is highly unique, and you know, maybe if I had to kind of spin it a little bit on AI, just to give kind of the reference point, one of the things that was unique about crypto was that these companies were built off of this composable system that just enabled you to be way more efficient in building the companies. And so many of them just right-size the business during these winters to hibernate, if you will, and to build along the way, but to do it efficiently. A lot of what we invested, frankly, was infrastructure. I mean, truly picks and shovels. Think of, you know, security layers and ability to kind of assess threats, things of that sort. So there weren't a lot of volatile NFT and like kind of investments. But I would say that a lot of them had the efficiency to be able to kind of weather these storms. And, you know, it's a macro bet, frankly, that you believe that this has the technology and the capabilities to be an underpinning of the financial community, if not other sectors. I would say AI has an interesting, so if I had to put a little negative spin on it, there's a lot of companies that were funded. And most of those companies are dependent on these LLMs that charge a lot of money. And we're getting more efficient by the day, you know, with ChatGPT Turbo and other things. These efficiencies are going to be passed on. But these companies are so expensive to run, right? The people are really expensive because there's a mad dash to go find those people. The token purchases, the models themselves to tap into those are very expensive to run. And so unlike crypto, you can't go into hibernation per se. So I do think you're going to see a little turn in that system where those 2.0 companies come out. But like in crypto, I think that's one thing that you've seen is a lot of really efficient companies form.
That's such a good point on the, you know, I think companies, the founders that raise money, at least at my stage, that when they get to Antonio, probably they're more sophisticated, but they'll be like, my revenue is going up like crazy. And there's some SaaS companies and their margins are like 10%, right? Because they're spending so much on running this software. They'll never make money unless they, you know, whatever, double their price. So it's really interesting. I think it will come down, right? And I mean, eventually will compute. It's like, that's what happens always. It will come down. But for now, we're stuck with this big, heavy CapEx on this software that we're building.
But you know, the one thing, and Mar, I'd love to hear your view on this. The issue ends up being that what AI has really done is enabled anybody to build, right? And the issue ends up being that buy versus build has just gotten compression in my view, right? And so people can whip up these companies quickly. So differentiation also becomes an issue in addition to the cost structure. So the question is,
Well, I think there
will
is
there be
like the
more
first,
competitors?
you know,
Yeah,
the
go ahead.
first generation. I always feel like in every kind of technology change, the first generation of folks are the hustlers, right? I'm really good at building, we're putting something out and so on. Now, who builds lasting companies? I think you're a little more thoughtful, or you know your customer or market really, really well, right? And those are companies that, you know, they will exist for sure.
Mhm.
Something, you know, what differentiates us like that company from the 30 other companies around. Somebody's going to do better product design, perhaps optimize it for a specific use case, et cetera. We're not there yet.
Yeah,
But
the question
yeah.
was like, maybe do AI companies have the longevity or the ability to be, because of their inefficiency, I would say, or will it, which I think it will, personally, is there a culling of the weeds much earlier?
Oh yeah.
Like crypto, I would say
Yeah.
there isn't that culling of the weeds because they all kind of hibernate, right?
Interesting. Antonio, what did?
I mean, I look, I would go, this is on the crypto question, right? Not AI. So we also invest
And then we'll
yeah,
come
bring
to
it back
who's
topic.
making
We
money in
also
AI.
invest on,
I heard there's
yeah,
a lot of money in AI going around. So go
exactly. Let's
ahead.
talk more about that.
Crypto first.
We also, our thesis in blockchain is also infrastructure, and normally go from infrastructure applications when we see like applications that are that have high return on capital, high growth. We didn't see that in blockchain, so we stayed at the infrastructure layer. And we had stuff like a wallet, an exchange. We have like a lender that does some cool stuff with blockchain. And I continue to think that there's two things about this that are important. One, it's a fundamental platform shift in how we track assets for finance, and two, it's a mechanism for financial freedom globally. I think both these things are true. And I think we shouldn't kid ourselves. The world's gotten more volatile. We see wars happening. The price of Bitcoin's gone up, right? If you're Ukrainian or somewhere in the Middle East today, you're probably buying Bitcoin. And if you're staying in Taiwan, you're probably buying Bitcoin too. So this is all happening, and it allows for a level of freedom that, used to say, I think it was Rothschild said it was like a third land, a third art, and a third jewelry, right? Just in case you got to go. Well, now it's probably a third Bitcoin, a third jewelry, a third art. I'm making a joke, but maybe 25% each. This is the reality. I own some for this reason. It's literally a hedge in my portfolio against financial disaster if I got to do something, whatever. So I think this is not going to change. This is my 30th year. John Shulkin, very well, we've been doing this for 25 years now at the firm. And it's, man, there's always a winter. There's always winter. There's always a spring. There's always a summer. It just happens. Bubbles always happen. It's abstracting back and knowing this is happening and knowing how to where to invest, where not to invest, having the patience and the capital get through the down cycles, which I think a lot of these companies do. A lot of great companies come out of this. A lot are going to die. It's about selection. That's why we're in business, right? That's why we're here, because we're good at that. If we're not good at that, we shouldn't be here.
So I mean, there's one question you were talking about all this money going. Who's getting the money? You're saying that startups are paying money. Is it the cloud firms, or is it the OpenAI? Who's getting the money? And then Antonio, you said OpenAI didn't have any competitive advantage. So I'm confused.
I mean, maybe I'll start here. What to clarify what I said. So they do have some reinforcement learning, but when we looked at it, it's a long story with OpenAI. But when their retail application came out, people thought it was sort of like an iPhone for everyone. It's not. The iPhone for everyone is really AlphaGo or AlphaZero, I think, where the machine could be strategic. This just allowed the popular press and the average person to think about artificial intelligence. The reality is they're cutting off the internet. They were probably, I'd say illegally taking the X Twitter feed, and then on top of that, they were doing reinforcement learning with humans in a closed setting. Then now you open up to reinforcement learning kind of at writ large, right? Well, that advantage is going to decline over time if you don't have custom data. And to Mar's point and Sach's point, the data center costs are exorbitant. So between developer cost and data center costs, it's a hugely capital intensive business. And
so Google and Microsoft then are in good, and Amazon.
I mean, they are. This is the reason you asked me earlier about Microsoft. I said, well, Azure is a great business. The people that own their own, run their own data centers, it's a great business. And the data center productivity numbers are very low. So the average GPU utilization in a data center is about 30-50%. This is numbers from NVIDIA. That could double given what's happening behind the chip in the data center. It's a huge opportunity for increased return capital and growth in the data centers today, and that will reduce the price as well. So, but you still have a very capital intensive business on one side for supply, for compute, and then you have very little moat in the business itself. I think those LLMs that have real moat, so Google, maybe Microsoft, I don't know, less so. I think actually Grok. I think that what X is doing, XAI, having the access to the X feed is seriously important custom data. I'm using the thing. It's great. By the way, let me pitch right now. Go sign up. You want to use this thing. It's funny. It feels very friendly. I feel like I have a friend. Use it. It's really cool.
Wait, now, are you an investor in X?
I am. We did not invest in the fund because we don't do turnaround.
Okay, but
I'm
you're
an
a
investor
person.
person. I put a large amount of capital at the family office into it, and I spent some time there last year working on it. So I do believe, and it is unbelievable data for sure. That's my answer to your question.
Cool.
I want to say one thing about crypto. See, I know there's winter, Sach, like you said, but it was such a huge peak. I think there's more volume in venture crypto investing this year than there was in 2020 and 2019 and so on still.
It was a hot summer.
Yeah,
it's
so
all
I don't know. It
relative,
depends on
right?
how you look at it, I guess. There's, but obviously much 10x lower than what it was in 2021, right? So depends on your eyes. And I think 9 out of the 10 largest rounds are infra for crypto. So Antonio's okay.
So okay, so now like we've got 10 minutes left. I've got a bunch of other things to talk about, so we'll go quick. So you talk about hot summer. ESG, how are you approaching those issues? Is that a thing? Has it gone down with the political flack recently? Where are we on ESG and the venture world and the tech world?
I can start. So, about 3 or 4 years ago, I had a young man come in from Harvard Business School, and his summer project was to think about ESG for us. He was the ESG manager at another large private from Harvard Business School. And he came, in addition to deals, he was the ESG manager. So he came in, I said, go look at this for us. And he came back to me and he said, I think you should just ignore this. And I said, why? I said, because you guys were doing ESG before ESG was the thing. We've been trying to make the world better. Before it was the thing, it was our thing, right? We try to make the world better. Investing was like Tesla forever. It's why we exist. It's why we're doing this. We try to hire people of different kinds, from different places in the world with different backgrounds and different stories, because I think it makes for better thinking and decision making. So we've naturally gotten there, and I think it's just good business, man. Investing in mission-driven companies, you attract the best people, because most people, the best people I meet these days, they want to work on stuff that matters. And building diverse teams, man, if you're smart, you look for diversity of thought, and that leads diversity of people, because that's how you get the best answer. And as a leader, our job is to bring in the best people, form our teams up, and get the best answers. It's the right thing. I don't need someone else telling me to do it. We're already doing it. And I don't think it's going to help if anyone else tells people to do it. You got to do it because you know it's the right thing to do. It's smart. That's my answer, Steve.
That's Mar.
I have much to add. We were small enough that we didn't even have to worry about ESG, so that's great. We've been doing climate investments for a long time. Obviously, we have a super diverse fund. So nothing to add to what Antonio said. I didn't even have to worry about it. I don't even have to check the box when I raise money. I'm too small.
So
yeah,
nothing to add.
Yeah, again, not much to add from what Antonio added, except for I would say that the corporate governance aspects of it are really interesting, right? Like increasingly more and more burdens are on corporate boards, whether it's cybersecurity, whether it's on this topic or others, right? And so I do think that it's starting to put a lot of administrative burdens on companies. And with that comes opportunity to kind of help make that efficient. But as an investment area, that'd be my just one additive point.
Okay, so talking about people, and we touched on this a little bit, is it easier or harder to hire people this year than it was a year ago?
For what roles?
Or the same? Or the same?
Roles? If you're, I don't know,
just general, whatever role, general.
If you're hiring an AI researcher, they're going for 10 million a year. So that gives you the number.
Okay, I'm gonna change my career. Okay.
Yeah, so get a PhD in AI. That's my.
I think Mar's right here. I think hiring at the firm level is easier. There's a lot of reasons for that. It's idiosyncratic to us, and the market's gotten better. Hiring, I'd say, very, very talented technical people across the board, it doesn't matter what the specialty is gotten harder. And I think that the returns to intellectual capital in the economy are going to keep going up. So the people that are really smart, well trained, they will get paid really well, and the capital between their ears will get more valuable over time.
That's ROI. It's another ROIC. Okay, we got to distinguish there.
I think it's a little bit like companies where you were saying, Taj, that the best companies have multiple offers and the price is so high. It's a little bit that rule, the 90-10, the top 10 is just so high, such high demand, the rule applies and, you have more flexibility on the lower end.
Maybe the one contrarian view I'd have, well, one I'll give on a fun level. I tried recruiting 2 years ago, and I was literally reaching out to people on LinkedIn to try to get them to apply to a job. You do it today, I'm getting inbounds. It's a very night and day difference from a venture perspective, and that's a venture macro. I will say company-wise, and we have like dashboards upon dashboards telling us metrics, but we also have a person on our team that all she does is support our portfolio talent recruitment. And I can tell you definitively, like the number of people that are in these functional roles like marketing, sales, CTOs, there's a lot of them on the street. And so if you're a specialist and you're high caliber in like, say, artificial intelligence, data science, areas like this, there's a lot of pull. But even the FANG companies have pulled back on recruiting. And I would say that the overall demand is such that most of my portfolio companies that are hiring, one just raised 25 million, they're able to go get whoever they want. And I think that the environment has also changed in that most of my companies are willing to recruit remotely, which has actually added that kind of benefit too. So very different hiring environment, I think, very different than what I hear in the news. And again, those are broad strokes, macro things, but I would say in the tech community, it's been a lot easier to recruit generalists as well as functional people.
I'm going to go a little contrarian here with Sach. I think that the remote work from home thing, I am so short.
Me too. Totally. I have this fight on every board that I'm on, trust me. And I'm in the office right now, along with most of my team.
If you want to be vocational, if you want to work in vocational training, and it's fine. But if you want to be trained to be anything senior, you got to show up and train. You got to help people.
And if you're a company that is remote, you're already losing, right? So I think we're making all our companies that had to be remote go back. It's painful, but if you want to win, you had to play, the right way.
We used to do this forever. It wasn't. I mean, we used to go to work at Goldman Sachs 5 a.m, leave at midnight. It wasn't painful at all. I was grateful to be there. I was grateful.
Well, and the funny thing was COVID was one aspect. And Mar, you incubate companies, you're in these early stages. Some of these companies started as remote first. So to unwind that, I think it's very difficult, right? Because it either means you part ways with people, you make them move. These are not those are systemic issues. I would say that I personally view that a lot of them are starting to hire in concentrated areas. And it's a thing over time that the culture changes, but.
Okay, so I'm going to ask one question, and then we're going to do predictions. So geographies, where VC funding's down in Chicago. Is Chicago and the Chicago audience more than others? Is Chicago good or bad? And then Mars in San Francisco. Antonio, I know, spends a lot of time in New York. So what's going on with geographies?
Well, I'm long on SF in New York.
Okay.
I think Mar's right about that. We're seeing a lot of activity in New York and San Francisco. I will say my San Francisco office collapsed during COVID. They all moved to New York. So I think some people are going back now, which is good. But on Chicago, look, I love Chicago. I was there for 25 years, raised my children there. There's a lot to come in the city. We are seeing some interesting stuff there. Like as an example, we have a company called Songfinch that's in Chicago that I'm personally going to work on their product, their AI product with. And we just had a meeting with them, and I'm digging in there because I think this is a great team, wonderful product experts, great technology team, and they can be very successful. So I think it's like anything, yes, it has its challenges, but there are always bright spots if you look. You need to look and support.
By the way, for Songfinch, I got, had them make a song for my wife for her birthday. It was like the best birthday gift she ever got. So just FYI and for the audience.
Yeah. Did you sing it yourself, Steve, or did you have one of them sing it? One of the
No, I didn't. No. Then it would have been the worst present ever if I had to sing it. So no, they created it and sang it, and it was great.
So just a little side here, they actually did something for John Shokin, our partners in the board. They remixed his voice, made him sound good onto a song, and had a Valor song they played at our quarterly meeting. that in his voice, it was great. He plays guitar. He's a pretty good singer, but he should keep his day job, right? But they remixed it, made him sound great. It was really cool.
Oh, that's great. Yeah. Okay, predictions, and then we'll be done. So from now until next year when we do this again, will IPOs be up or down relative to last year's pretty low bar? Up or down? Such?
I say up, and I'd say second half of the year.
Mar?
Up.
Antonio?
I agree. Up.
Okay. Up. Good. Dollars invested in venture capital.
Up.
Such, Mar?
It's up with a asterisk. I think it depends on stage.
I'm gonna say down.
Down.
Let's see next year. See you guys next year.
And VC fundraising?
Flat. Tough.
Flat.
Very tough. Yeah.
I think more to less funds. I think there are a lot of early stage funds that won't be able to raise.
Okay, and then last one, will the number of new unicorns be up or down?
Hmm.
I'm gonna say up because it's so low. It's lower
what
than
was
it
the number?
was.
I'm
in
not sure. I need to check.
2016.
I don't know the number.
Mar's playing the denominator game here.
I
Got it.
can make
You got
it up
it.
It's
this
so
year.
low if you compare it to anything before 2020.
She went math, and she was already doing spreadsheets on this.
I'm gonna agree with Mar. She's in the Midas list. She knows what she's talking about. I'm with her. Whatever she says is right.
Totally.
Okay, we are actually over time, so I'm going to say number one, you heard AI is a juggernaut. It's going to keep happening, and it's sounds like more Star Trek than the Terminator. And I want to thank, my coffee machine is going off, so you'll hear some noise in the background, perhaps. I want to thank you all. This was, I hope if the audience had as much fun as I did. It was fantastic, and I look forward to seeing you all next year. So thanks again.
Bye, Mar.
Thank you, guys. Thank you, Steve. Thank you, Margaret.
See you.